Imagine a landscape where every window represents a financial decision that could either anchor your future or sink your liquid capital. For years, the real estate market felt like a one-way escalator, relentlessly climbing toward the clouds. But today, the atmosphere has changed. We are witnessing a monumental pivot where price stabilization is no longer a forecast. It is the current reality across major residential hubs. As buyers analyze the latest property shifts, the urgency for a definitive exit strategy has never been higher. This isn't just about selling, it's about the sophisticated science of timing. In this deep dive, we break down the complex mechanics behind the stabilization trends that are currently redefining our skyline.
The latest data from the core central regions suggests that the feverish bidding wars of the previous decade are finally cooling into a calculated equilibrium. This stabilization isn't a sign of weakness, but rather a maturation of the market. Across major residential hubs, the transaction volume is beginning to mirror the actual utility value of the properties rather than speculative hype. Savvy investors are now looking beyond the surface-level asking prices to understand the underlying absorption rates. By examining the velocity of sales in these core areas, we see a clear pattern emerging. Buyers are becoming increasingly price-sensitive, forcing sellers to recalibrate their expectations or face prolonged listing periods in an increasingly crowded and fast-moving competitive marketplace.
While some see stabilization as a plateau, the astute observer recognizes it as the precursor to a significant structural shift. The psychological barrier of entry has moved, and with it, the traditional buy and hold mantra is being rigorously challenged. We are entering an era where the cost of waiting might actually exceed the benefits of appreciation. This cooling mirage suggests that while prices seem steady, the liquidity of certain assets is quietly evaporating. To navigate this, one must look at the granular shifts in buyer sentiment and the tightening of credit conditions. The era of easy gains is behind us, replaced by a surgical requirement for data-driven decisions that prioritize liquidity and strategic exit timing over a Now, let's peel back the curtain and look at the raw numbers through a vibrant digital three-dimensional heat map. This visualization isn't just a collection of pretty colors, it is a thermal representation of capital flow across the nation. Notice the high-intensity crimson zones, where premium flats are still moving with surprising velocity, despite the broader cooling trends. These hotspots indicate pockets of resilient demand, where scarcity and prestige continue to defy the gravity of rising interest rates. Conversely, the expanding blue regions signal where momentum is stalling. By mapping these trends in real time, we can identify exactly where the market is breathing and where it is holding its collective breath, waiting for the next big catalyst. The resilience of the premium flat market remains one of the most intriguing anomalies in the current landscape. Even as cooling measures take hold elsewhere, high-end residential units in prime districts are maintaining their allure for high-net-worth individuals seeking a safe haven for their capital. These assets are often viewed as a hedge against inflation, benefiting from a perceived floor in value that lower-tier properties lack. However, the data reveals a narrowing gap between the ask and the bid. Even in these luxury enclaves, the exit strategy must be meticulously planned. Buyers in this segment are more informed than ever, using sophisticated analytics to justify their entry points, making the seller's data-backed transparency more critical than ever before today.
In stark contrast to the premium surge, we are seeing significant stagnation zones emerging in the mass market periphery. These are the areas where cooling trends are most visible, often characterized by a surplus of similar inventory and a lack of unique selling propositions. For homeowners in these regions, the window for a high-value exit is narrowing. The heat map shows a distinct fading of activity, suggesting that the secondary market is struggling to keep pace with new launch prices. This divergence creates a dangerous trap for the unprepared investor, who assumes that a rising tide lifts all boats. In reality, the market is becoming highly bifurcated, rewarding those who can distinguish between temporary dips and permanent.
Synthesizing this data allows us to see the macroeconomic pulse of the property market. When we overlay interest rate trajectories and employment data onto our heat maps, a complex picture of the next 18 months begins to form. We aren't just looking at bricks and mortar, we are looking at the collective financial health of the population. The cooling trends we observe are often a direct response to tightened global monetary policies, yet certain micromarkets continue to thrive due to localized infrastructure developments. Understanding this synthesis is the key to mastering the real estate exit strategy. It requires a transition from viewing property as a static home to viewing it as a dynamic, data-driven financial instrument of growth.
We now face the ultimate strategic crossroads. Do you cash out on your current equity or hold out for the upcoming public housing exercises? This is the pivot point that defines your financial trajectory for the next decade. Cashing out now allows you to lock in the substantial gains made during the recent bull run, providing a liquid war chest for future opportunities. However, this move requires a clear plan for where that capital will go next. Equity is only valuable if it is deployed effectively. With the market at a stabilization point, the opportunity cost of staying put is rising. You must weigh the certainty of today's profits against the speculative potential of tomorrow's uncharted market conditions.
The upcoming public housing exercises introduce a new variable into the exit strategy equation. With the introduction of new classification models, the allure of these launches is undeniable, but they come with stringent conditions that impact long-term flexibility. Holding out for these exercises might mean missing the peak of the private market cycle. It is a calculated gamble on the future value of prime and plus locations versus the immediate liquidity of your current holdings. Investors must analyze the minimum occupation period as a potential constraint on their agility. The decision to hold is essentially a bet that the future utility and location premium of these new flats will outweigh the immediate financial gains of an exit today. Risk management in this climate is less about avoiding danger and more about managing leverage. As interest rates remain elevated, the cost of debt is a silent killer of long-term returns. A successful exit strategy takes into account the total cost of ownership versus the potential for capital appreciation in a stabilized market. If your mortgage payments are eating into your equity faster than the property is appreciating, your hold strategy is actually a slow-motion loss. Diversification into other asset classes might offer a better risk-adjusted return during this period of housing recalibration. The goal is to remain agile, ensuring that your real estate portfolio serves your financial goals rather than your financial goals serving your property debt. Looking forward, the new structural classifications of residential property will fundamentally reshape the investment landscape. The distinction between standard, plus, and prime housing is not just a naming convention. It is a fundamental shift in how value is perceived and preserved. These classifications will dictate the resale potential and the demographic of future buyers, creating a tiered market with distinct growth ceilings. For those planning a decade-long horizon, understanding these nuances is non-negotiable. The impact on long-term returns will be profound, as the prime labels likely command a scarcity premium, while standard flats may face increased competition. This structural evolution means that your exit strategy must be as sophisticated.
As we conclude this deep dive into the real estate exit strategy, one truth remains clear. Information is the only true currency. The next decade will not favor the lucky, but the prepared. By leveraging data-driven insights and understanding the psychological shifts in the market, you can navigate the stabilization trends with confidence. Whether you choose to cash out today or hold for the future, ensure your decision is rooted in the heat maps of reality rather than the whispers of speculation. The property market is a marathon, not a sprint, and your exit is just as important as your entry. Stay informed, stay strategic, and let the data guide your path to long-term wealth and residential stability.